Good morning, everyone. I'm Steve Ankerstar, and welcome to the Ankerstar Wealth, a morning show. Our normal host, Allison, has her last final this morning at the University of Alabama, and then she's done for Christmas break. So very excited to have her back as part of the show here, starting hopefully tomorrow morning. But today we're going to talk about three things in the market. First of all, we're going to talk about some 2023 predictions. These are not my predictions, but they're predictions that were on CNBC today, that are all interesting. So I'm going to talk to the three of those. I think one's going to happen. The other two, I think, are unlikely. But we're going to go peel those back a little bit. We're also going to talk about, if you want a safe haven for your money, 5% CDs. So if you got 100,000 sitting in the bank, doing nothing, you could be in a 5% CD making 5,000 for the course of the year. And if you're not making it, guess who is? The bank. That's right. They're putting that money to work and, making the 5% and then giving you your, 15 cents a month in interest or whatever it happens to be. Right. So we're going to talk about 5% CDs. And the last thing, it is the end of the year. So one of the, some of the main things you look at are required minimum distributions, which are largely done. Got a few of those still hanging out there. If you haven't done yours, check on it sooner than later, because paperwork takes a while towards the end of the year. But the other thing we should be looking at is tax loss harvesting, which is simple in concept, but in practice, it's a little bit more challenging because you don't want to throw the baby out with the bathwater sort of thing. You don't want to just sell stuff for the sake of selling that you were going to wish you held for over the long term. So that's what we're going to talk about today. Before we begin, though, as a reminder, it's a financial education presentation. You have to do your own due diligence for acting upon anything you hear in this presentation. More disclosure information is available at ankerstarwealth.com. Now let's get started. All right, let's take a look at these predictions that are brought to you on CNBC. And let's see who it is. Standard Charter. I don't know those folks, so I'm not vouching for them. But they laid out three predictions. The first of all, laid out three predictions. The first one is collapsing oil prices. So we do have a war going on in Russia and Ukraine. I know you know that, but as far as what that does to oil prices, the large supplier of oil is Russia, so it's going to keep those, prices high. And with everything going on with, OPEC and everything else, they're predicting a collapse. No, I wouldn't say they're predicting it. They're saying there's a likelihood of the collapse, and I would say I'm not so sure that that's the case. However, they do kind of throw should there be a resolution of the Russia-Ukraine conflict, I would have to imagine if somebody was if you had to bet for or against, is this thing going to wrap up in 23? You'd have to think for, right? I mean, it probably, wars are expensive on both sides, obviously, not just in the cost of life, but in the cost of, treasure as well, treasure being resources. But I even if it wraps up, I'm not sure we're going to see oil just, cratering, if you will, to a much lower level. It seems to be stuck higher for longer. I don't really see that. So I would say I would disagree with the first one. Second one they throw out there is the Fed cuts rates by 200 basis points. This one I do think is likely. So let's talk about that. Right now, this year, they've raised, over the course of 2022, we had inflation at the beginning. They raised 25 basis points, then 50, then 75, 75, 75, 75. There's four there, if I said that correct. So overall, 3.75 to 4% we've raised this year. We're projected to have another 50 and then another 25 in January, 50 next week, 25 basis points in January. Altogether, that's around 4.5 to 4.75. That's about right, and then we're going to hold. Now, here's the issue with that. When we raise twice more again, which again is a projection, then we're going to try to hold. Well, the problem with holding is that it's just too easy to start lowering rates again. So it will depend on when we finish raising rates, how much of a recession we have. There's a chance that we don't have one. Unlikely. We probably have one. And, of course, the Fed's shooting for that soft landing. So it's a small recession, kind of like we already had in 2022, even though the government says we didn't. But if we have one, if it's small, then no big deal. But if it starts to become a larger recession, then that's, the first thing you do in order, to combat that is, again, lower rates. As soon as we cut rates, man, the market's going to scream higher. That would be insane. I do think, though, if you wind back to the beginning of 2022, when we started on this rate hike thing, I said the natural tendency is for the Fed to overreact to the upside. And that's not a spear. I'm just saying that their job is to take care of inflation. So let's raise rates too much to make sure we kill off inflation, and then we'll solve the rate thing later. So you're kind of trading one problem for another, but then again, you mature out of that one too. And the theory is that everything will be right, which is a better option than to go in slowly. And now inflation's a problem for 1, 2, 3, 4 years, that sort of thing. So I do think they will overshoot to the upside. I think that we will start dropping. Will it happen in 2023? I don't know. It kind of depends on how bad that recession gets. And there's going to be other factors out there, right? But overall, as far as this prediction, I like it. I think, 200 basis points, that's 2%. I think if we start cutting rates, we're going to probably go all the way back to zero, to be honest. The last one out there is say tech stocks fall even further. I disagree with this. I think the bottom's in tech stocks. The NASDAQ says, you can see the headline there, closed Monday down more than 29% since the start of the year. I mean, it's been exhausting. It's been, for those that are with me, yeah, we got out of speculative stuff, but we're holding best of breed. It's a flight to quality all the way at the beginning of 2022, and it's hold that quality through the year and the downturn. Tech is different, right? We talked a little bit about it on Monday. We talked about the long-term, annual gains of the NASDAQ are larger than any other index that's of the main indices that are out there. And so that's where the return is. I think that's going to come back. When it comes back, it'll come back with a vengeance. So I don't think we're going to see tech stocks falling much further. Okay, so that wraps up the thoughts on predictions there. One of the three I think is actually going to happen. All right, let's talk about if you just want to move to safety. I get it. No problem. I see that. I say it every day. It's just like, hey, people, it's like, where do we put money to work? And it's been largely wait and see. We did start nibbling into CDs around the 4% level. Now they're up at the 5% level. And if you buy these things, just realize there's a couple things that are going to happen. These are brokerage CDs. These are not at a bank, right? That's very different investing. If the bank offers you a CD, it's going to be a lot lower rate. You're going to have to hold it to term or face a penalty and not much of one. I mean, usually it's whatever the percentage is for the last quarter. So not much of a penalty, but there's a small one. Or you hold it to term. Okay. In a brokerage account, this is where the big brokerage houses, this is a TD Ameritrade display. This is live from this morning. So you can go out and buy a brokerage CD. You can see these are at par, meaning $100 is the par price. Once you buy it, and there's a 9 years, 5.2% CD from Celtic Bank. You can't buy this in Texas. We're in Texas. So look at the next one, 5% for an 8-year out there. And yeah, you're going to basically just get this money while you hold the CD, preferably to maturity, right? And if somebody said, hey, for the next 8 years, I'll give you 5% on your money, that's pretty attractive right now. Okay. Yeah, the market sometimes and sometime in that 8-year period is going to come screaming back, and you're going to be like, oh my gosh, what am I doing in this stupid CD? Well, then you're being greedy, right? So, sit back, relax, think, I've got 100K in the bank. I can put it to work at 5%. That's 5,000 a year. That's 400 and change a month. Yeah, that seems pretty smart. And that's now your safe money, right? It's a CD. If you go into investment grade bonds, you're just not going to get that much more return for actual risk, right? Because now you have to, you have the investment grade bond risk sort of thing. So I think this is kind of a no-brainer to have your safe money put away into CDs now. Now, what's going to happen to this? Let's talk about that, FNBO or the FNBA there at the bottom. CD at 5% in 8 years. What happens if the rates continue to go up, which they're projected to? Yeah, you bought it for 100. It's going to have a market price, unlike the one at the bank. So it may drop to 99 or 98 or 97. You don't care because you're going to hold it. Okay, so you hold it through that time. hold it through that time. And when or if and when rates start coming back down and they go back below where they are right now, which I think will happen in 23, maybe off to 24. Now your CD is actually worth more than 100 because you can turn around and sell that now. You can see that both of these are callable. A lot of the CDs that are coming out right now that offer these higher rates are callable. What does that mean? I'm glad you asked. That means the bank at any point in time, not really like any day, but they have a schedule, either once a month or once a quarter where they could put into call all some or none of the outstanding CDs, meaning they just buy it back from you and they buy it back at par. So you're going to get, if they call it, you're going to get your money back, and you will have gotten 5% for however long you held on to it. So how do I think it all plays out? If you're, with me and you're putting folks into 5% CDs, is as soon as rate starts coming down, whether that's next year or 24 or 2025, at that point, the bank's going to call this thing back. So you're basically going to get 5% until the bank retires it, right? They call it back, they retire it, and they give you your money back, and they stop paying you that 5%. So since they have this callable function, that reduces their risk, right? Because they can just buy it back and stop paying that interest. So I think it's a good place to have your safe money. So do your own diligence. Make sure you do understand it's going to fluctuate in price, which can drive some people crazy. But you plan on holding it. If you buy it, don't buy it unless you plan on holding it. Right. That is the point. All right. Last thing I want to talk to you about is tax loss harvesting. So that involves selling. Once I can find my screen here, that involves selling something at a loss. And a lot of people would literally rather, smash their forehead into the wall than sell something at a loss. But it can be a smart move for taxes. So let's talk about selling things for a gain first. So this again is Investopedia as the source here. That's open source, written at an understandable level. So when you make a gain on a stock, so let's talk about the gains first. You buy a stock and it moves up and you sell it and you make that money. That's a capital gain, right? You're taxed at capital gains at favored rates versus income. However, if you have a bunch of capital gains, or if you sell a business or a house and you exceed the certain level where you're going to have a capital gains tax, you can offset those with capital losses. So in a situation like 2022, where there have been losses, if you have things that you bought that you choose to sell for a loss, you can be able to offset your capital gains with these capital losses. If you only have losses, or you offset all your gains and you still have losses, then you can offset up to $3,000 of your taxable income, which for some of you that's a lot. Some of you that's just a drop in the bucket for if you have a high salary, but it still counts, right? So there's times when you look through a portfolio. So that's the theory. In reality, what do you have to do? You have to look at your holdings in your portfolio. You don't want to sell a best of breed stock just for the tax. You don't want to let the tax tail wag the investing dog. But if you see something in your portfolio that either has been irritating you or you're ready to give up on and go with something else, then that would be the perfect thing to cut, i.e. sell and realize those losses. So you are locking in those losses for tax purposes. So sometimes you can be more aggressive at this. I'm a little tentative to do it just for the tax savings, right? Because if I'm just going to buy it back in 30 days, then that's kind of silly. But it's something you can take a look at. If you're working on your own, you can look through your own portfolio. If you're with me, I have a software called Riskalyze that actually scans portfolios for tax loss harvesting opportunities. So I get those presented to me every morning when I log in, and generally, nope. But every now and then I'll see something like, okay, I could sell that position now. And then I can either choose next year to buy it back or not. So all of the selling I do in December, I basically, for the wash sale rule, to make sure you don't mess that up, I basically wait until February before I would buy it back. So as long as I sold it sometime in December and I wait until sometime in February, that's when I will go back in and repurchase the same thing if I want, or something substantially similar. Okay, so that's the basics of tax loss harvesting. Let me see what I missed from the key takeaways. Reduce taxes, everybody likes that. Involve selling an asset or security at a loss, yes. And then there's the wash sale. Don't sell a substantially identical investment within 30 days. Okay. All right. That's the basics of tax loss harvesting. And that's all we got for today's show. Thank you so much for listening in. Please continue to submit your questions to me. Again, that's where I get these ideas from. That's all we have for today, and we will see you back in tomorrow.